Welcome to Patterns and Profits. I'm Tom Gentile, America's #1 pattern trader, here to discuss the patterns that are developing right now with SpaceX and the SpaceX options, which have just launched. So be sure to help me out here. Like, subscribe, and comment on the video. It really helps the channel. Now, before you place your first trade using SpaceX options, especially if you're new, you've got to understand the foundational rules of the game. So for those of you that don't know, an equity option is simply a financial contract. It gives you the right, but not the obligation, to buy or sell a stock at a set price within a specified time frame. That's as an option buyer. Now, every option contract is defined by three things. Number one, the strike price. Now, this is an agreed upon target where you can buy or sell the stock. Number two, the expiration date. Options are decaying assets. Each of them have an exact date when the contract becomes void, and these dates can vary. And then finally, the premium. Now, this is the price you pay for the option or the cash that you would pocket if you sold the option. But here's the most crucial rule for beginners. It's something I call the power of 100. Every single option contract represents exactly 100 shares of the underlying stock. So if you see a SpaceX option trading for a premium of $5, you're not paying $5. That contract controls 100 shares, meaning the actual cash cost or the premium is 5 multiplied times 100, which equals $500. So keep that multiplier in mind, because that's the key to both your risk and your leverage. In the options market, you only have two vehicles to trade, calls and puts. Let's break them down. First up, call options. Think of a call option as a voucher to buy shares later at today's prices. When you buy a call option, you're bullish. You believe SpaceX stock is going to go and rocket towards Mars. So, for example, if SpaceX is trading around 180, you might buy a $200 call option. If the stock surges to 220, you still have the legal right to buy those shares at 200, allowing you to capture a massive upside with a fraction of the capital it would take to buy the actual shares of SpaceX stock. So this is a big deal. This is leverage. Now, next up are put options. Think of a put option as insurance, or like an insurance policy. When you buy a put option, you're typically bearish, or you're looking for some protection if you actually own the SpaceX stock. So a put option gives you the right to sell SpaceX stock at a specified strike price, no matter how low the market or that particular stock drops. If bad news hits or the broader market is correct and SpaceX plunges down to, say, $100, holding a 150 put means you can legally force someone to buy your shares from you at 150. Remember, calls look for liftoff. Puts protect against a crash. Now, let's talk about real-world risk management. SpaceX, it's a monumental company, but let's be honest. Post-IPO stocks are notoriously volatile, and the options on those stocks when they come out are historically expensive. Plus, with a $2 trillion valuation right now with SpaceX, there's going to be a massive tug-of-war between the bulls and bears. If you were lucky enough to acquire SpaceX shares at the $135 IPO price, or even near the $160 market debut, you might be sitting on a great profit right now. But what if you're worried about a short-term pullback? What if the upcoming earnings report causes a temporary drop? And that might happen because they've never issued earnings before. This is where you use a strategy called a protective put. This allows you to hedge against the stock. So because you own the shares, you can go into the newly listed options market and buy one put contract for every 100 shares of SpaceX that you own. So for instance, if you buy a 150 put, you've just established a hard floor for your investment. That means no matter what happens to the stock market, your downside is protected, and it's legally capped at $150. Think of it as the premium you pay for the put is exactly like premium that you might pay for car insurance. You hope you don't need it, but if the wreck happens, you're incredibly glad that you have it. So next question is, what about protection without paying the insurance premium? Because sometimes these premiums can be expensive, and with SpaceX, they are right now. This is where a covered call comes in. A covered call involves selling one call option for every 100 shares you own. But in this case, you're receiving premium, not paying for it. So what you're doing by selling a call option is you're obligating your shares to be sold at the specified call strike if the buyer exercises his or her right. And you're being paid a premium for this obligation. So, for example, if you believe SpaceX will sit below $250 a share for the next 90 days, maybe you'll consider selling the 250 calls and collecting the cash premium. So long as SpaceX doesn't go above 250 by the expiration date, guess what? You keep both the premium and you keep the stock. So the stock can go up and you can still take the premium as long as it doesn't go up too much. And while this doesn't limit the downside risk, it does cushion it with the premium that you collect. Now, here's a big question a lot of you might have. What if you don't own the SpaceX shares yet, but you want to at a lower price? If you look at the current price right now, let's say it's sitting around 180 or even 200. You think, I love Elon's vision, but I'd rather buy the stock if it pulls back to 135. So instead of sitting on your hands and setting a limit order, you could use the options market to get paid to wait. This is a strategy called selling puts or writing a cash secured put. So when you buy a put, you pay a premium for the insurance. But when you sell a put, you become the insurance company. Now, here's how it works. You choose a strike below the current market price. Could be something that's just a few strikes below, or it could be something really, really deep. Let's say the IPO price. Let's say that you want the stock at $135. So you sell the 135 strike. By selling that contract today, you're legally obligating yourself to buy 100 shares of SpaceX at 135 as the stock falls at or below that price by expiration. In exchange, the buyer is paying you a premium up front. So that cash is deposited directly into your brokerage account today, all right, just upon selling that put option. What happens from there? Well, only one of two things can happen. Number one, SpaceX stock stays high and never drops below $135. If that happens, the option expires worthless and you have no obligation to buy the shares. You keep 100% of the cash premium when you sold the put as pure profit. You could turn around and do that again as often as you like. Or number two could happen. SpaceX stock drops below 135. You're assigned the stock and you must buy 100 shares at $135, the exact price you wanted to buy it anyway. It gets better because you still keep the cash premium up front. Your actual net price is even lower than $135. Now, whether you're buying calls for leveraged upside or protecting yourself with capital with puts or covered calls, or maybe you're acting as the house and selling puts like I just did for cash flow, the game has officially changed. This is absolutely incredible. If you found this breakdown helpful, hit that like button, subscribe to the channel, and drop a comment below. Are you buying or selling SpaceX options today? Thanks for watching. I'll see you on the next one.